All right, welcome to the show, folks. My name is... Welcome to the program. I am your host, Dastardly Dave Star, and let's get right into the news. Today, folks, a lot of people have been talking about this Zero Hedge article written by Zero Hedge, who I don't like. I'll just say that right out front. I've never been a fan of Zero Hedge, mostly due to a lot of the political malarkey that they've put up. But this recent article has made a lot of buzz in the VIX/trading world. So I did want to bring it up because people have been asking about it. Sorry for the delay. I had to reset my computer as it was having some memory issue or something like that. But let's go to the my recent Twitter feed here and see if we can find this this article from Zero Hedge. Now, what it's talking about is call buying and how the basically the VIX. Here we go. Here's the article. The VIX is being affected, and the whole market's being affected by a bunch of people buying calls in various issues. And why am I not able to drag this? And my whole comment on this is this: we don't really have a whole lot of proof of this. Okay, so here's the article. It says, yesterday morning, we, together with Nomura's Charles McElligott, explained why traders are furiously chasing the classic gamma crash up in the market, which has become a classic feedback loop. So the theory here is that a bunch of retail people bought a whole bunch of calls in certain products, and thus somebody out there is short all these out-of-the-money calls. So basically, they're just envisioning like that the whole market is this one position where somebody is short like a zillion out-of-the-money calls, and that the whole market has to kind of like is just like this one big position of like a front spread where they're short these calls, and so if it goes up, then they've got to furiously buy up all these tech stocks, and if the market goes down, they've got to furiously sell them back out to cover this position of being short these calls. And it's an interesting theory, but the thing is that for every person that sold one of these calls, there's another person who bought the calls, and the person that bought the calls at the same point where supposedly the person that short these calls is furiously buying stock to protect their position, same person that owns these calls is when the market does rally is either going to sell the calls back out, right, or they're going to sell stock against them. So the positions offset themselves, as most positions do. So I don't 100% buy this theory, although it's gotten a lot of press. But let's take a look just ourselves, and let's take a look at Apple volatility for a second. But I want to come back to, and then I'm going to get onto the term structure because I want to talk about the term structure and about, and I just want to walk through with you. I think we should just walk through rationally together, like what's going to happen. When's the election? Which futures involved with the election? What do we see happening moving forward from here to the election? And let's just talk out this term structure a little bit. If you have to go because the market's opening in 5 minutes, that's fine. You can watch this video later. But let's look at Apple. I want to look at Apple just open interest for a second, just to see what we can see ourselves about open interest on these calls and all that. Because I don't buy this whole thing with the short call theory, and people give market makers too much credit. I saw somebody else online before saying, "Oh, market makers pinned Apple to a specific price on expiration." Assuming that market makers have this like this power above everybody else to affect pricing, to which I've talked about this many times. Being an ex-market maker, there are brief moments in very illiquid securities where somebody can nudge something one way or another. But beyond that, it's very difficult to manipulate stuff in your favor, because what happens? Someone bigger comes along and can run you over very easily. So let's say you're trying to keep Apple at the price of 130, and so you're selling 131 stock and you sell a bunch. Well, someone can just step in and just buy all you have to offer and push it higher than you, because there's always someone bigger than you out there. But let's go to Apple just to take a look at the open interest really quick. So what I'm doing is I'm going on Thinkorswim here, and I'm pulling up Apple, and then I'm going to go to all products. Now here's the options screen. We're going to go to options. We'll look at the options screen, and then I will adjust. I'll go up to the middle top here of the screen, and I'm going to select for volume open interest. Now open interest is going to show you how many contracts are outstanding. Remember with options trading, it's an agreement between two parties, right? One person says, I'm willing to sell a call at a price, and you don't have to own an option to sell it. You enter into the contract. So when a series starts, there's no open interest. If somebody decides to sell a call, now there's one open interest. If that particular person, if the person that sold that call, if there's one open interest in a call, and the person that bought that call from them comes back and buys that call back in, then the open interest goes back down. But we can track this stuff. So let's take a look. Now the problem is that I don't have statistics on what is usually the open interest in these strikes. However, you can see here the open interest, and this is just September 15 expiration. You see these sizes, 44,000 calls, etc. These are out of the money calls here, right? All of these are out of the money calls, and that seems like significant numbers, right? 30,000 on one strike, 40,000 on another strike. That's, several 100,000 out of the money calls that are there, right? Meanwhile, let me just mention while we're here that Nasdaq is currently down 187, E-minis down 22. Dow futures down 42 as we approach the open here. VIX up 3 cents. Term structure, I've got all these VIX futures listed down here, and we're going to talk about that in a second. But yeah, so as we look at Apple and we look at out of the money calls here, we do see evidence that there are some pretty large numbers of call trading right here. Now here's 11 SEP expiration. We've got 18,000, 21,000, 27,000. Now I don't trade Apple every day, so I'm not familiar with what this usually, what was this, post pre-split, but these seem like pretty big numbers to me here. Look, 96,000 open interest here on these calls. Now the put open interest is on the side here. And I see 64,000, 58,000 open interest here. So these numbers seem pretty large to me, right? These calls here. Let's go. Now, the yellow ones are weekly expirations, and the white ones are monthly. We used to just have monthly, so you'd expect to see kind of bigger numbers on the monthly. And these are some decent numbers here, right? 108,000 on one strike here. So we definitely see that there is a lot of trade in Apple. But once again, we don't know specifically who's doing what where. And in a sense, these people offset each other, right? It's not like one party just sits on their position and does nothing about it, and the other party is the one who hedges their position. There's two parties here, and how each party acts. Actually, there's way more than two parties, right? There's thousands of people involved here, and the behavior of all of these thousands of people is ultimately what moves the market. And so when you say, when you try to characterize it as it's just one big position of somebody who's short out of the money calls, or essentially short gamma, short front spread, as we'd say, market makers would say, short gamma, that's just. Certainly there could be positions like that out there, but there's also people who, somebody owns all these calls that were bought, right? So that person wants the market to move, and when the market moves is going to be, if the market moves up, they're going to be selling some stock against those potentially, or they're going to be selling them back out. So just because there is open interest in a strike does not lead you inevitably to some conclusion that it's like dangerous for the market or the market's acting weird because of that. So I don't see really this evidence for this theory. And like I said, I admit freely that I don't like this guy from Zero Hedge. So that's probably part of it. Greetings to all of you. Will Tesla drop $20 in the first minute? I don't know. Tesla's down 30 right now. VIX up slightly. It kind of should be. We've seen. All right. So let's get into the VIX and all of this volatility stuff, as you might say. And I'm going to pull up the term structure here. We have seen massive levels of contango, and this is a weird looking chart, right? It was for a while. It was just front month was down and other months were up. Let me see if I can move this over here. I'm having issues. It was just for a little while that the front month was low and every other month was high, but now it's getting to a situation where like only October is the highest and everything else kind of streams down from there. So the whole chart would be, I'm like slowly, gingerly moving this over to the other side, and it doesn't want to do it. The whole chart would be in backwardation if it wasn't for like the front month, right? But there we go. There we go. Perfect. I have to baby these computers sometimes. All right, so here is our chart. Let's talk about it. And of course, it's blank now. All right, there you go. So we have seen this space between the September and October futures steepen over time, right? This was 15%, then it was 12%. I'm sorry, it was 12%, then it was 15%, then it was 19%, and now it's 21%. It was up to 22%, right? We've got this future, the front future is going to expire on the 15th, right? Today is the 3rd, right? So we've got a little less than 2 weeks till this expires. Now, these two have to converge. The spot price, which right now $26.83, and the future $28.80. So that's $2 of space. And it doesn't seem like much when you look at this chart right here, but that's significantly higher width than we usually see, just that space between these two. And not to mention the space between this October future and spot. And one of the big point I want to make here is that, okay, when's the election, right? The election is after this October future expires, right? So why is the October future so much higher than the November one? The election is in between the October future expiring and November, right? So this will be gone. This future that's up at 35 will be gone before the election. So my idea is that we are going to see once this, we're going to maybe get a move. We don't know. The VIX could move up higher, but either way, let's say things kind of go on like they have been, not that much going on. This future, this OCC future is going to have to curve down, and when we hit the election, it will be this NOVE future that's the one in play. The OCC future will have expired already. And my understanding of why these futures are so askew is that people are wanting to keep buying this October future and sell the SEP, right? So the more they do that, well, the market makers and the futures traders, they say, all right, well, let's just make the spread wider and wider. If they want to pay, right now it's showing that the difference is $6.25. If they want to pay $6.25 for the spread, let's just keep raising it until sellers come in. It's called price discovery. So if this spread keeps, if this width isn't wide enough today and people keep buying that OCC future, then they'll raise it even more. And as they move this stuff out of whack, this is creating a situation that does give edge to the downside over time. And, people have been saying it's broken, it hasn't been working. But what's essentially been happening over the last month is a VXX of 28 at the beginning of the month. VXX of 28 represented a future of 28.80, right? But by the end of the month, a VXX of 28 represents a future of 35. And that doesn't sound like a huge difference, but it is. So essentially, as the effects of Contango continue to occur, you're essentially you're moving up what price VXX represents for volatility. So VXX around 25 represented a future of, let's say, 26. Now around 28, it represents a future. Now we're halfway through the expiration cycle, right? So right now, VXX around 28.50, it represents pretty much a 50-50 split between these two futures. So if you took the halfway point between these futures, you get what, like 31 and change. So now VXX at 28.50 represents a future of over 30, right? So so as Contango continues to erode things, if you're short, you're kind of trading up where you're short from. So instead of being short from, if there was no Contango and this month went by, then your VXX, if you'd sold it at 25, would be as if you'd sold futures at 25. But now after the month has gone by, a VXX of 25 would be as if you sold the futures at like 30 something. It's slowly getting moved higher. Let's say your average cost of where you were latching on to this short vol trade. So as time goes by, if you're short these products, you're slowly moving up where you're short from. And that doesn't automatically make you money. The only way you're actually going to make money on this trade is when futures move lower. If futures just keep moving higher, it doesn't matter how much you adjust your cost basis, right? It's great if, oh wow, I actually was only selling a 30 VIX instead of a 25 VIX. If VIX just continues to move higher and higher and higher, you're still not going to make money on the trade. But the longer we stay at these really high Contango levels, you could think of it as moving up your cost basis for where you're selling the VIX. So, and my feeling is that or my understanding of what's going on here is that if we kind of just keep staying in this situation, this future is going to expire, the SEP one, and this AUK future is inevitably going to have to curve down and making the NOV the highest future. And then we could be in a situation where this Contango continues up all the way to the election. And if that happens, that is going to give us essentially 75 more days in this situation, which is going to continue to raise your cost basis in, if selling VIX at 28 represented me selling, if selling VXX at 28 represented me selling a 45 VIX, that would be awesome, right? Because the likelihood that VIX is going to be lower than 45 is much better than the likelihood that VIX is going to be lower than 30. And so we're kind of playing chicken right now. If when and if the futures move down, we are kind of like locking in more and more edge or more and more potential to the downside as we sit in this Contango situation. However, if we get a big spike, if the market moves way lower or something and we get a big spike in volatility, VXX is going to move higher inevitably. So so the jury is kind of still out on this situation. Every day that goes by where we sit in this heavy Contango, it is helping the shorts because we are adjusting our cost basis slowly up higher to where we are latching on to that VIX short. However, we have to wait and see what's going to happen. But this term structure is kind of acting like the election is during or before October expiration, which it is not. And so inevitably, if the event doesn't happen, whatever the event which this is showing that everybody's scared about, if that event doesn't happen until the election time, then this future inevitably has to curve lower, and we are going to get some sort of down move in these products. I hope that maybe just gives you something a little bit more to think about with this stuff. Let me pull up and see my room here. Hey, what's up, guys? Hey, Edward. Right. October expiration is on the 20th in 47 days indeed. We are 47 days out, so basically an expiration and a half out. And yeah, it can be confusing when you first started getting into this stuff, because if you look at the chart, you see. If you look at the chart behind me, you see ARK and NOV, and you think ARK, oh, that must be the end of ARK, but it's not. And Edward's talking about a vaccine. I wouldn't be surprised. Obviously, the Trump administration is trying to make the case for another 4 years, and so if they can get some sort of vaccine announcement to come out, that would be great. But we've been in this term structure for a longer period than the vaccine speculation has been for. So I would take that this shape of the term structure has to do with more than just the most recent news of the vaccine. And also because of the fact, and a vaccine announced, I don't see that as having the potential to accelerate a huge down move in the market. A 35 VIX would imply some sort of big move, and most likely down. I think you'd agree with me on that, Edward. So I see this term structure. I see the term structure as just the inevitable result. Let me show my face when I say this. I see the term structure as the inevitable result of a bunch of people wanting to hedge their positions, okay? Now, certainly there's some call buyers out there that have been, buying calls in these techs that have been going straight up. But there's also put buyers out there in the S&P from fund managers hedging their position. A lot of fund managers missed out on the initial rally, right, in March, April, when we sold off. A lot of people did not get back in the market right away. And so they're chasing returns because they're trying to get back to the return of the S&P 500, which is the benchmark for fund managers. And so fund managers have their hands tied. They don't feel like they have the ability to get out of these long positions in your Tesla, Apple, and whatnot, because they don't want to miss another move up, and they can't afford to. So instead, they buy put options to protect themselves to the downside for a down move. And there's just not enough supply of protection in this marketplace because it continues to build the demand for protection, the fear of what's going to happen coming up. However, my point here is that October is not the key month. Potentially, October is not the key month. Whatever is going to happen would happen after that. So there is potential in my mind that October melts and NOV becomes the key month. And the way I explain the fact that ARK is like higher than everything else right now is just a supply and demand issue in S&P options and options in the market in general. I find it interesting how, just to change subjects for a second, I find it interesting how people are all of a sudden talking about an Apple VIX or a Tesla VIX. Options traders have been talking about the volatility of options on a stock for a long time, and we don't call it a VIX. The VIX to me is a specific duration. It's about the S&P 500, and it's specifically 30 days out, right? So if we pull up the S&P 500 here, and we were to look 30 days out at option implied volatility. Now, when I pull up the screen behind me, if you look to my right here, you see these numbers. This is the implied volatility per expiration, right? And if you're looking like less than 5 days to expiration, it's probably not super accurate because you're coming right to the end of things. But you see, as we move out in time, about 30 days out, we've got a 26, which corresponds very closely to the VIX, right? VIX is 2691 right here. So when you've got Apple VIX, basically what they're doing is they're taking Apple and they're isolating the one options chain that's closest to 30 days, which is probably, out here around 57, 58, and they're making a new indicator out of that. I don't think that's necessary. I think if you want to know Apple volatility, you can just pull up the screen and you can look at the different months and see what vol is in different months. Now, this number on the right side is kind of an average. If you pull up a specific month and you look at implied volatility, there's going to be a skew, right? The out-of-the-money puts are going to be higher than the out-of-the-money calls, and I don't really want to get heavily into that right now, but suffice to say that the number that's shown on the right here is kind of an average volatility for stuff. as we have the NASDAQ selling off and the VIX not really responding. I don't think it should be too surprising to anybody that the VIX is not responding too much to this down move. I mean, we've had the VIX slowly moving up during up moves, and the realized volatility, what the realized volatility is how much stuff is actually moving around. And stuff is actually not moving around as much as the VIX is saying it is, right? The options prices in the S&P are far higher than is justified by how much stuff's moving around. And once again, that there's just more buyers than sellers, and people want to own this stuff, and thus prices have been driven up. But if we go ahead and I pull up SPX on my screen here, and I pull up a chart, I can go ahead and I can take a look at what the actual historical volatility is, and I'll show you the way I'll do that here. Is I'll just go in on the top here under studies, I'll pick studies, I'll say add study, I'll go down to volatility studies, and then I'll pick historical volatility. And this is showing volatility right now. And important note about this is when you're pulling up these studies, you want to look at the duration, because the duration is going to be important to this. But if we look here, it's slowly been moving up, but the average volatility right now is around a 7, right? Okay, the VIX is 26, and we're moving at only a 7, right? So what that means is that option prices are way higher than we're actually moving, and thus there's always pressure to bring these prices down. So even with SPX down 19, there's pressure to bring those prices down, because VIX ultimately is not a directional thing. Yes, VIX tends to move more when we get a move to the downside. However, VIX is a measure of volatility, how much stuff moves around, and stuff is not moving around a lot. Now, there's fear out there that stuff is going to move around a lot. That's why prices are jacked to the moon. But as time has been going by, stuff hasn't really been moving around a lot. So that's kind of where we stand. I am short VXX. And the reason is because what I explained about the term structure. Now, when we've got a 22 Contango, what that means is that, and I kind of like the idea of explaining it. It's not the exact mechanism, but explaining it as your cost basis for what price you sold VXX versus versus VIX futures. So as time goes by, your cost basis for what price you're getting in at that short at is moving higher, and it's moving higher by almost 20 cents per day. That's what the current level of Contango is giving us. So what we can do is we can take VXX, and you're not going to see it really super clearly, but we can take VXX and we can plot it on a chart next to the VIX to try to isolate that decay over time that we've been talking about. So if we go under style here and we compare the VIX to VXX, we should see VXX underperforming the VIX over time, right? Because that's where your edge is in that VXX will underperform over time. So I'm going to go under studies again, add study, and I'm going to do compare with, and you can't see what I'm doing because it's on the other screen, compare with VIX. And once again, what time period we're dealing with is always important here. So you can see it doesn't show it super great, but you can see that over time, VXX is underperforming the VIX here. And if we look back over time, we are in a huge level of Contango right now. I'm going to pull up one of Edward's favorite charts if it doesn't take me forever to move this stuff back over here. Let's see. All right, so we'll pull up one of Edward's favorite charts here real quick before I let you go, which is our Contango chart, right? Now, this is showing levels of Contango over time. And remember, we spent a lot of this year actually in backwardation where the VIX VXX was actually underperforming the VIX because we were in backwardation. But right now, look, we're way up here. Anything above this red line means that term structure is decaying. I don't know why that just happened, but let's try to do that again. So we are at a mega level of Contango, and it would be a beautiful thing if we could continue for like another couple weeks in this very steep Contango, because it will work over time. Eventually, if we stay in Contango and the market doesn't move, eventually this house of cards will collapse and these products will move lower. However, if you're planning too short term, you could get smoked. So I would caution people about putting all their eggs in one basket with this sort of thing. But if we don't get too much of a market move, what I see happening is a staying Contango, and then when SEP expires, the chart looking kind of similar to what it is, except later AUK being the future that's curved down and NOVE being the top future. And if that indeed happens, if the same structure stays in place over the next month, then and we stay at a high level of Contango, this short position will work. All right, so let's go and say hi to you in chat. What's your thought on UVXY? Please forgive me. Oh, Jonathan Batista. Yes, I am short. However, I'm not like let me just explain to you. I'm not like a perma-short person, and I understand that there's a case for both sides, and there are many people on the show who are both long and short. So don't think that we are not friendly to people who are long this stuff, and there is certainly a case for the longs, and let me make that case now. One of the things I like to do, and I think that makes me in a way unique as a commentator, is that I like to make the case for both sides. Now, the case for being long volatility is very easy. That is the fact that we have rallied like crazy, ridiculous rally with the overall economy not justifying it, right? There's bad news in the economy, right? Having to do with, well, unemployment is still very high, right? The no end in sight for the COVID. Now, COVID is becoming less of a worry. Why is that? Well, for one thing, science is getting better. Medical stuff is catching up. The U.S. didn't have the greatest response, to this, but medical science is catching up. Not as many people are dying. We're learning more about this COVID thing, and we're learning that it basically affects the oldest in our communities the most, by far. And testing is getting better. The race for a vaccine is coming. I don't think that there's some magic vaccine that's going to put everything to rest, but I think that slowly this is going to become less of an issue. However, people were out of work for a while. The economy hasn't come back. It's hurt those who are the lower wage earners the most. It's certainly hurt like the hospitality industry. Think of restaurants, conferences, obviously the cruise ships, travel on airplanes. It's hurt these things a lot, and yet the market has gone straight up. So there's definitely a case to say that we're going to get at least a down move, some sort of correction, if not a bigger down move at some point. And thus, that is really the case for being long vol right now. I mean, look at the NASDAQ chart here. I mean, it has gone straight up. I mean, how is that sustainable? Look at NVIDIA, right? Well, that came back a little bit. Look at Salesforce. Look at Tesla, right? These things have made these big moves up, and actually some of them have given back a little bit here, which I think is healthy. But there is definitely a case. Look at Lulu, for example. I mean, look at Wayfair. Okay, this thing has just exploded to the upside. It went from 21 to 349, right? Amazing. So there's certainly a case for there to be a big move to the downside. But the thing is in the background, this whole time, vol has been creeping up. If the VIX were down back around 10 or something, then it would have the potential for a huge explosive pop. But the volatility has been creeping up so much, it's very hard to get a big spike when you're already above like a 25 VIX than it is if you're at a 10 VIX. Because remember, 10 VIX, 100% move is up to 20. Right? Now, you can get a 100% move from a 26 VIX up to 50. Of course you can, because the VIX got to 85, right, during the most recent thing. Let's take a quick look at the VIX chart, because you want to stay in perspective about where we came from and where we could go here, right? This is where we are, right? It feels like we've had this big up move in vol, but it's just a little pop off of, it's like we're still in a downtrend almost. We've just had a little pop compared with where we were. So we certainly can go higher from here. But it doesn't have that coiled spring potential huge spike as it did if we were down around 11, 10. Vol's been creeping up. Certainly if we do get a big down move, nobody can say, I didn't see it coming. We didn't know this was going to happen. It's not going to be a surprise to anybody, because half their news articles in the world have been, the market's going to correct, market's going to correct, market's going to correct. There's been massive protection buyers out there. And all of these things the vol creeping up, people buying tons of puts, all these articles, people thinking about the downside, all that to me is contrary evidence that we won't get a huge down move. There's a lot of people out there, and in my mind, it seems like there's a lot of people out there who are sitting on the sidelines going, I can't wait till we get a correction so I can buy the dip. And if everybody's buying the dip, then it just doesn't go down that much. So the case for the long vol is that things are going to get more hectic ahead of the election. And there's certainly a case for that, right? Things can certainly get more hectic ahead of the election. Things can certainly move around more. The NASDAQ's down 250 right now, and I've hardly mentioned it, and people don't see that probably as even a big deal, because stuff's been moving around so much, and that's a sign of the times here. Stuff can get a lot more volatile. I don't have info on a put-call ratio, and I right at this moment, and I don't want to start talking out my ass, so to speak. Are you a bankster? I'm not sure what that means. So that's kind of where we are. It's not surprising to me that with the S&P down 25, that the VIX is down right now. And the reason that's not surprising is this is kind of like the most healthy thing the market could do, is backing off a little, right? The scary part is when the market goes straight up, straight up, straight up every day. Having a little pullback like this feels healthy, feels like, it's a scenario that you can understand. It tells a story, and it makes sense to me that vol would be in with a little pullback, because this is healthy. Edward, please delete that bad word out of my commentary. Hey, what's up, Wyatt Parsons? Thank you for your support on StockTwits. I appreciate your kind words. I don't have a regular streaming time. If I would suggest, the drill. Put the bell icon. I try to announce a little bit ahead of time. I'll announce on StockTwits and Twitter when I'm going to stream, but I don't have a regular time. I hope to get more regular with it. I often stream before the open, a little bit before the open. The market, all right, I don't like to talk politics too much, obviously, but somebody said something that made sense to me the other day, which was, with Biden predicted to win, the market is not going to be totally taken by surprise if Biden wins, right? Because Biden's predicted to win right now, and the market's not stupid. They see those predictions. I do believe the Vegas odds and stuff. I know that we all remember 2016 where the pollsters got it wrong and Trump won when he wasn't predicted to win. Now, I think people are taking more open mind at this point. The election obviously is not in the bag for either person. Biden has the advantage right now. In my opinion, you can disagree with that if you'd like, and that's fine. The banksters caused the riots. I think the do I think the banksters caused the riots? No, I think that when you talk banksters, it makes me think of disparity of wealth in the United States, and I think rich getting richer and poor getting poorer is a big problem, which I don't know how to address. It's beyond the scope of this video to start talking about political theory, I believe. Banisters. So there's banisters and bankers. What is Lulu? Lululemon is a company that makes yoga pants and high-end sports equipment. They just bought a company that makes exercise bikes also. Wayfair makes high-end furnishings, think fancy beds and bed sheets and whatnot. And both companies have benefited from the shutdown because people bought stuff online. Also, Lulu is a multinational, and they benefit from sales multinationally in China and whatnot. Lululemon has earnings coming out in a few days, I believe on the 8th. And the thing has gone straight up. And, I had the idea for a little while of like, oh, well, yeah, I'll get short Lulu. And then when this whole house of cards come down, I'll make $1 zillion. And guess what? Let's see. Dave does not truck and compares. The Dems did. Okay, so you guys can argue amongst yourself over who's destroying the economy. I tend to believe that, and this is not going to be a popular theory with anybody, but I tend to believe that 50% of the population can't be wrong either on the Democrats or Republican side. So, not to sound like the president when he said there's good people on both sides, it's more complicated than that. I try to stay out of politics. If you were to nail me down, I'm a progressive. Okay, so I'm a progressive, which is kind of the farthest on the left side. I'm surrounded by everybody around me are conservative Republicans, like my family, my best friends, and whatnot. Anyway, so that's kind of where I stand. But I don't go out there and talk trash against other parties and all that kind of stuff. Basically because, I have a lot of respect for a lot of my friends who are on different sides of the aisle. And I think it's healthy for me to engage with people with different beliefs because, I'm not going to convince anybody else of anything, but I might be able to change my own beliefs by talking with other people. So it seems pretty clear that the election may not be determined on election night. How do we play that? We'll wait until a little bit closer to that time for that. A great thing would be able to put on some sort of vol position and take it off before the election, right? Make money between now and then. And certainly, it's hard because if you get long vol, you've got these headwinds, right? There's decay working against you. If you're short vol, you've got the fact that we're kind of heading on the edge of a big cliff working against you. So there's a case for each side, and I can't tell you exactly what to do. Lulu is a tough stock to short. And it's one of those ones that in earnings could go, it could go straight up. I have a lot of friends out there who have been long this market the whole time and are like riding up Tesla or riding up Apple and have made a ton of money. And I think sometimes, maybe I should have done that, 2020 hindsight, I suppose. But those who just can't, if you just come in March or April and just said, I'm going to buy the dip here and just got long the market, you would have made a ton of money. Forget all this VIX stuff, forget options trading and whatnot. Well, don't forget options trading. You could have bought some Apple options or something. Even if you just identified before the split, hey, the split is going to be good for Apple or it's going to rally into the split, you could have made a ton of money just being long this market. And that's a great irony. But I know for myself that I can't, if I go out there and I buy a Tesla right now or I buy an Apple right now, it will go straight down. That's guaranteed. Why are the VIX and SPY, why were they moving in the same direction? Well, the short answer to why the VIX and the SPY were moving in the same direction is easy to understand if you understand what the VIX is. The VIX is a measure of option price levels in the SPX. So the higher the SPX seems to move up, the more nervous people are that it's going to make a big move down. So each time it notches up, more people come in and they buy put options. They buy protection to protect them to the downside. That added to, and I believe there is some truth into this whole zero hedge thing, that there's people buying out of the money call options. When we do make a move up, if we continue to move up quickly enough, that's a problem as well. Now, we haven't really been moving up super quickly, even in the NASDAQ. I mean, it's been moving up, but it's not like there's no time to adjust. There's been time to adjust. But the short answer for why the VIX has been moving up when the S&P moved up is just the VIX is not, it's not dependent on up or down. It usually moves down when indices move up. Part of the reason for that is the S&P is on a skew, and as we move up in the skew, it's lower numbers higher up. But we are in a unique situation where people are very afraid of a specific event, being the election. It's just this scenario where we've had a huge rally. People didn't think we were going to rally. And we did. We've had this huge rally in techs. People have made a lot of money, and they're willing to take a small portion of that money to protect the downside. So they go in and buy puts. And the higher we move, the more puts people buy, and thus the VIX has moved up as the S&P moved up. Now, sometimes when there's like an event about to happen, something really scary about to happen, a war or something, you'll see like a day or two where the VIX moves up with the S&P. But that doesn't seem to be like what's happening here. This seems to be more of a different scenario than just, oh, well, you see the VIX move up one day when the S&P's up, and that's a red flag, and we're going to have some huge move. That doesn't seem to have happened. What has happened is over a period of weeks, we've had the same scenario where the markets continue to rally, and people are getting more and more nervous that, forget the election. If we didn't even have an election, people would still be nervous that this market was going to sell off at some point, right? So the more days we have this beautiful straight up move, the more scared people get. In a sense, that's why now with a day of a sell-off or a couple days of a sell-off, that nervousness kind of disappears because they're like, oh, well, the market's acting more normal now. It had a pullback finally. So that's, I'm not going to, the banksters are in a meeting. Yeah, I'm not sure why today appears to be slow. It was interesting. Being a floor trader, you'd stand there, and you never know what's going to happen. Some days are just totally dead, and other days it just goes nuts. It's like, and it could be totally dead, and all of a sudden you'd hear like a roar from somewhere else, and it would all of a sudden it would go nuts. So you never know what's going to happen. Is Trump going to win again? I don't know. That's a good question. But let me make one point, though, is that let's say somehow you knew who was going to win the election. It doesn't necessarily mean you'd be able to make money one way or the other. It seems like somebody who, like, let's say you just got out of high school and you just started studying the market last week. You might have this sort of like, retail common knowledge that, oh, well, Republicans are better for markets than Democrats. So if Trump wins, the market's definitely going to rally. And if Biden wins, the market's definitely going to sell off. I would caution you against that because this marketplace is far more complex. There's thousands of people. Just imagine the market as just thousands of people coming in and making plays, doing this and doing that. And the market is a sum total of thousands of people's inputs into things. And so to predict what's going to happen, even if you knew ahead of time who is going to win the election, is very difficult. Why Trump isn't bailing out the banks? Well, if you're talking about aid packages, there are aid packages that are, the stimulus is going to come back up again soon. It's been kind of delayed. The government has to pass legislation by, I think, October 1st, authorizing more funding for various things. So the Democrats and Republicans have to come together on this essential package October 1st. So that's potentially a point where they have to get this stuff through. But they are a long ways apart on what sort of stimulus they want. All right, so there you go, folks. I've been jabbering long enough. Remember, my opinions are not any more important than yours. Everybody has a right to an opinion. And I wish you the best of luck with trading moving forward. It's not obvious what the perfect trade is. It's not obvious, and it's not obvious what's going to happen. That's the way the market is. I would suggest for people just to get comfortable with the uncertainty of we don't know what's going to happen, as opposed to trying to say, well, I'm going to figure out what the market's going to do tomorrow. Get used to being comfortable with not knowing what's going to happen and just start to accept that we just don't know what's going to happen. When I see somebody come on and say, oh, this is definitely going to happen, or I laugh, because how do they know? They don't. Anyway, so there we go. All right. Well, the stimulus, the parties were apart, and then we had all this vacation stuff, and then they had to go both do their own conventions, and meanwhile, things haven't happened, and it's unfortunate. We'll see what happens going next. Currently, the VIX up 27 cents, with the market S&P 500 down 35, NASDAQ down 276, VIX only up 27 cents. This would be surprising under other conditions, but in the market we've seen over the last couple of weeks, nothing's really that surprising. Thanks, guys. Yeah, I would like to see the unwinding of passive investing too, but I don't see that happening. All right, thanks everybody. I'm going to roll it. I was trying to do the Keemstar before. Roll the closing credits. Yes, I'm wearing earbuds. I hope Trump will deport all the Democrats. Interesting. Everybody's entitled to their opinion. Bye.